Hello and welcome to Hilltop Wealth Advisors Economic and Market Update for the first quarter of 2020. I'm David Wise, and with me today is Ben Yeager.
Thanks, Ed. Glad to be here.
Thanks, Ben. We have officially moved into our new office space, so we're excited to announce that. So we're filming from our new spot. With that being said, there's been a lot of changes at Hilltop, but when we think back to 2019 and how the economy and market performed, maybe we could recap what we saw.
Certainly. So we had a really good year in 2019. The S&P 500 representing U.S. stocks was up over 31%. The EFA index representing international stocks was up over 22%. And even the bond market, the U.S. aggregate bond index was up over 8% for the year. So some really good returns in both the stock market and the bond market, which was really nice to have. Kind of a rebound from 2018. But as we looked into the economic conditions, we actually saw a little bit of slowing. So the U.S. economy grew at 2.3%, which is a little bit slower than previous year. And the global GDP overall slowed to 2.7%. So not bad, but slower than the average.
Yeah, and I think a lot of economists are pleasantly surprised to see just how resilient the economy has been over the last 10 years. And that slow and steady growth that we've seen has resulted in some pretty good returns over the last decade.
Yeah, and so I mean, looking back the last 10 years, we've seen really stimulative central banks, both here in the U.S. but also abroad. Specifically in 2019, there were 3 rate cuts by the Federal Open Market Committee, cutting rates 75 basis points all the way down to 1.5 to 1.75% on the Fed funds rate, which is very, very stimulative. So that has really helped push markets and the economies along. But on the other side of the coin, we have some trade tensions, and that's been around for a number of years. We are seeing some developments here as of late with U.S. and China, and they've got a phase 1 deal put together. However, some of the more meaty topics are still on the table for future years, potentially this year. So we'll see where that goes. As we look to abroad, there still are some tensions with the U.S. and the EU with trade. We'll see how those work out. But really what the EU is dealing with right now is Brexit with the UK. And there's some recent headlines and developments there as well. So as we look into 2020, maybe you could share a little bit more on that.
Yeah, I would say overall our expectations are a bit tepid at this point in time, both here in the U.S. and abroad when we're looking at the economy and the markets. We've had such a good ride over the last few years, and coming off of such a strong market last year, we wouldn't be surprised to see some additional volatility and maybe one of those 10 to 15% pullbacks that we've historically experienced when you look backward in time. With that being said, we're cautiously optimistic that the market can continue to move forward, but the ceiling isn't as high. And we don't want to lose sight of where we are in the economic cycle, being in the later stages. One of the particular trends we're paying attention to is just the tightness overall in the labor market, so we want to be cognizant of that. And not to mention the fact that we are heading into election season, which definitely can shake things up.
Yeah, so we're getting a lot of questions about that right now, and certainly a big part of the headlines throughout the year. What should our expectations be?
I think right now is a good opportunity to kind of take a step back and see what history tells us about how the stock market does during election years, but also the bond market. And so we wanted to share a graph that shows you just that, going back to 1928. And you can see that the stock market and the bond market really don't care who is the new president or what party comes into favor at that point in time. And hopefully that's a good reminder to us that although anxiety tends to heighten around these time periods, the markets and the economy tend to move forward regardless of who takes power.
That's really good to know, Dave.
Yeah, and I think a few other items that we're paying close attention to are, one, higher valuations. And with higher valuations, we don't see the research suggesting that they're excessive at that point, so not seeing a bubble right now, which is important. But also with higher valuations comes potentially lower annual returns over the next 5 years. So we want to be cautious and set expectations over the next 5 years. When you just think back, the last 10 years have been great for growth. We haven't experienced a recession. And so it's hard to imagine that we'd have similar 10 years going forward. The next item that we're paying close attention to is the coronavirus. That's been in the headlines more recently. And we can look back in time again to 2003 when China had a similar SARS virus that came into play. And luckily they were able to combat that, contain it, and they only experienced a mild impact from that on their overall economy. So that's some good news. And we hope that we see the similar case with the coronavirus. And last but not least, the Brexit, which is on everybody's mind abroad, and just how that impacts the overall economy and those countries in the EU surrounding Britain will be important to see. They're hoping to get negotiations done by the end of the year, so we'll be paying close attention to that. So Ben, just to kind of take another step back, when we're thinking about having discussions on planning, but also addressing the risks that we're seeing in the overall economy and market, with respect to our client portfolios, what are we talking about in those meetings?
Yeah, so we've definitely made a few adjustments from the risk perspective in client portfolios. Our investment committee has proactively made some adjustments in the models over the last year, but we're also having a lot of conversations with clients about what their risk score is and how that relates to their financial position and their attitude towards risk as well. So we're going to continue those conversations this year, and we look forward to talking to you all about that. But also, if you're not a client and you're not sure what your risk is in your portfolio, now's a great time to do that. We'd be more than happy to provide an analysis and talk through that with you, and just make sure that you're in the appropriate position as we head into this more volatile time period. With that being said, thank you, Dave, thank you all for watching. We hope that you enjoyed it and learned something. If you have any questions, feel free to reach out to us. Also, visit us on our website and check out our Hilltop Views blog.
Thanks for watching. Have a good day.